Hi, I'm David Bodemer, the editorial director with National Real Estate Investor, here at the Commercial Real Estate High Net Worth Investment Conference in New York City, here with John Schultz from Onyx Equities. How are you?
Great, thank you.
Thank you so much for joining us.
My pleasure.
I think it's you spoke with us last year as well at this conference, and you've come back again, so I guess we did something right.
Always a great conference you guys put on.
And so you're speaking on the non-traditional real estate investment panel. So can you tell us a little bit about like what that's going to cover?
Non-traditional assets to me could be a lot of things. Just like when people classify what high yield or distress is, it's a lot of different, I would say, communications and definitions of that. Non-traditional to me is where you go into a market and buy an asset that has a certain use, and you're either bringing it up to another level or changing that use. I think today, more than any time, because of the market cycle we just went through and the level of distress that assets went through, that we brought our basis back to the place where you can actually invest in something and be very creative. It's not the market forces, the cap rate compression that's allowing you to make money. It's actually getting back to real estate 101, having a plan, learning how to execute that plan, knowing your market, being what we call a really good real estate operator that stuck to their roots during the good cycles and the bad, and know how to actually take advantage of creating an asset into maybe what was non-traditional into traditional, or vice versa. So that's sort of how we look at it.
So it is about like management, leasing, purposing, figuring out like looking at this piece of real estate, and it's not like buying like a Walgreens, like that you're just going to hold this thing. We're not a yield type buyer. Listen, today, which is very interesting, if you just look at where rates are, it's been very hard to find yield for your money. Bonds, treasuries, everything you went out traditionally to make a return on has been suppressed or compressed. So real estate is an actually terrific way to find yield. Now, you can find it in two ways: by what you just said, by buying net leases, and core real estate, traditional, I guess you can call it real estate, stabilized, or you can go in and be what we are, as a very much a value add player that can go make something better than what it was or different from what it was, but starting sort of from where the asset needs to be worked from the ground up. And that's our business plan in our private equity funds. And so when you're communicating with the investors now, like the people that may not, if you're an expert in real estate and you like the kind of stuff that you do, you understand these assets, you understand like what it means to invest in a building, what it means to kind of go through these paces. Now, like an investor that's just like weighing their options and seeing, this may, like, how do you get them comfortable with that kind of a thing?
You get them comfortable by understanding the person they're investing with first and foremost. Nobody will ever understand unless you do what I do, as much as I understand what I do. So you got to get over that hurdle. First, do you trust the track record, the person, the integrity? Do you look back and see that they've stuck to their roots, and in a good market and a bad market, have you done well? Where have you done well? And you make an investor sort of understand the person, the market area, and sort of your business plan. But the other thing, this is an illiquid investment. This is not liquidity investing. Liquidity investing is in the stock market where any 1 minute you can get out. You have to know that if you want yield, which is what we're willing to offer today, you need to know you have a much longer horizon to get it. If you don't have the stomach where you can't call up and get your money back at any one point in time during a process or a cycle, then we may not be for you. But if you want to attract what we think is great risk-adjusted returns in a market that also is a hedge against inflation, real estate's a hedge against inflation, then I would want to invest in real estate if it was my money at this point in time, because I can't really find much yield anywhere else. And if you are a high net worth individual, you have lots of money that needs to be deployed in different places so that you have a well-rounded portfolio and sort of a hedge against your longs and your shorts. But we're in a liquid fund. So
Right.
like you can't, you can't get your money out like when you call.
Right. So I mean, how long is the investment horizon then?
Well,
with your
we like the ability to, we like capital gains, right?
Mhm.
So, in our business, if you hold on to a piece of real estate for a certain period of time, you can be afforded that benefit of capital gains tax. So, that's usually a year. But real estate could take 2 years,
Right.
3 years.
Yes.
I mean, if we get lucky with a plan, maybe it's way earlier. If we don't, then it could take the 2, 3, sometimes
Right.
4 years to fix an asset. It's a living, breathing building that has tenants and leases, and there's no quick decisions
Right.
from anybody today on their growth of their business. So we have to get through this cycle and be patient
Right.
with how the market's moving, how companies are growing, the changing needs of companies, through technology and all these disruptors that you read about.
Uh-huh.
It's changing sort of how people operate their businesses. So we have to be really cognizant of who's going in and what our plan is, not just to start, but what's our end game. And if we really, plan out and know the markets that we go in and feel comfortable that we have the relationships to bring that to bear, we'll do well, because you're back to where real estate was now valued at a place way lower than it was 4 years ago.
And when you're dealing with this kind of investors as well, are you dealing with, how much is it dealing with them directly versus like advisors, like their advisors? Is it a bit
Most
of
of
both?
our fund is direct to the investor. Some are through advisors. I would say the majority are direct.
Okay.
They want to see, feel, and touch us. They want to understand who we are. They were entrepreneurs. They built huge businesses.
Right.
Now they made a lot of money. They want to invest it. So they really like the getting to know who's going to operate for them in that sort of asset class, right? Then you have others that have advisors, family offices, and such, that you meet them. But you're always meeting, at least in my experience, and we don't have many of them, you're always meeting who the investors are actually going to be, regardless if there's an advisor or not, at least the ones that we've dealt with.
Right. And how are you getting, I mean, how do you even get in contact with that
It's a
pool of
lot
people?
of years of just being active in the business, being involved in stuff like this, getting out and meeting and greeting, having great integrity in what we've done since the beginning, and people, going out and sometimes, hopefully most of the time, saying nice things about what we've done. Your investors, if you've done well, are your greatest cheerleaders, right? That's the best form of marketing you could possibly have. So we've been fortunately we've done well, and we're slow and steady, trying to move through the next part of the cycle, and just do well and have fun, and hopefully that'll breed new investors for our funds to follow.
Great. Well, thank you so much for taking the time to answer some questions and for speaking at the conference again.
My pleasure.
And thank you for watching coverage of the event, and continue to watch our series of videos.